So what's my theme on China? That growth is slowing in China, but we should welcome, not fear, the growth slowdown in China. I'm going to try to convince you in the 17 minutes left that it's good for China and it's good for the world. And I'm going to make 3 points. It's 3 S's, so I can remember them without looking at my notes. That yes, growth is slowing. That's point 1. Second, it's slowing to a safer speed. And 3, it's more sustainable. So slower, yet safer and more sustainable. And you got it. It's exactly like the track analogy. China was running at a speed that was too fast. So slowing down is a good thing. By slowing down today, it's going to end the race faster at a better spot. And that's why it's good for the world. So now I'll go to the real story. Let me start with the first S, which is safer. So growth in China last year was 7.4%, and growth in the first quarter was 7%. Indeed, this was the lowest since the Asian financial crisis. Actually, it was a tiny bit higher than we thought in the first quarter. I think we had forecast 6.9, so we were a little bit off. We've been arguing at the IMF since last May, so since a year ago, that growth this year in 2015 should be between 6.5% to 7%. So actually, we're quite comfortable with the slowdown in growth in China. Our forecast for this year is 6.8%, and our forecast for next year is 6.3%. So while it's really tempting to describe a growth slowdown with adjectives like disappointing, weak, soft, it's rare to describe slower growth with adjectives like it's a good thing, it's good for China, it's good for the world. But I'd argue in this case, this is what's appropriate. That's the slower. Now let me turn to the safer. Since the global financial crisis, in 2008, the so-called Lehman shock, growth in China has relied on an unsustainable pattern of rapid growth in credit and rapid growth in investment. It worked very well to support growth, also worked very well for China to lift up the global economy, but it's not sustainable. So what we're seeing is China's moving to a pattern of growth that's much more sustainable. Let me pick one figure. At the IMF, we love facts and figures. China has this measure of credit. It's a very broad measure of credit called total social financing. Tries to describe how much credit goes to the non-financial corporate sector and households. Just think of it as credit. When China was booming in the 2000s, that figure was around 120, 125% of GDP. It didn't go up. Since the global financial crisis in 2008, it's gone up to about 200% of GDP. So we've had a more than 50% increase, or 80 percentage points of GDP, in the 6 years since the financial crisis. If I had a chart, you would see a line is going way up. That's a pretty good definition of unsustainable. There's other indicators that suggest the pattern of growth was unsustainable. Investment in China is quite high. If we look at, in particular in real estate, there's been a very rapid growth in what's commonly called shadow banking. That's financial intermediation that takes place out of banks. If that helps explain it any clearer, I doubt. All of these factors, we're hoping prop up growth in the near term, but we're not sustainable. So part of moving to a safer growth path is basically unwinding these imbalances. Last time I checked, there's no way to have less investment, less credit growth, less real estate, and less shadow banking without less GDP growth. Those just go hand in hand. Effectively, it means less stimulus is going to mean less growth, but it's a much safer growth. And indeed, if we look at why growth has been slowing lately, it's exactly for these reasons. Credit growth, or this TSF, was growing at about 20% year on year. It's down to about 13%. I told you we like facts and figures. If you look at the flow, not the stock, but the flow, in the first quarter of this year, it was minus 18%. That is, there was 18% less credit injected into the economy in the first quarter of this year than there was last year. Last year, there was 5%, around 5% less than the year before. This is an example of unwinding vulnerabilities, and this is an example why it makes sense that growth is slowing in China. So that's the slower, and the safer. Now let me turn to the more sustainable. Clearly, slower growth by itself is not an objective. Anyone would want to grow, any economy should want to grow as fast as they can. So the challenge that China faces is to boost its sustainable growth rate. That is, to move to the fastest sustainable growth rate. And here, I think there's some good news. First, China has put out a comprehensive reform plan that covers not just macroeconomics, but many aspects of the economy that will help move China to this more sustainable growth path. The second thing is China itself recognizes this, and it's adjusted its growth target. So the growth target last year in 2014 was around 7.5% growth, and it came in at 7.4%. The growth target this year was lowered to around 7%. It's an acknowledgement that the government understands the importance of moving to a slower, more sustainable growth path. But ultimately, just like the runner, how fast China can grow in the long run, how fast I could run in the long run was going to depend on my training. In China, it's going to depend on implementation of these reforms. There's been some progress to date. We can look at the financial sector, where we see progress on interest rate liberalization. There's been progress on strengthening regulation and supervision. If we look in the fiscal sector, there's a new budget law that was just passed and being implemented this year, so we can point to tangible signs of progress. But there's still a lot more work to be done. And here I'm going to steal a lot of the themes from the previous speaker about innovation, what in economics we like to call total factor productivity. But basically, you can think of it as innovation. It's how do I get more growth with the same amount of capital and the same amount of labor? How do I use my input, my capital and labor better? The third plenary reform agenda, as it's called, or China's reform agenda, is very comprehensive. I'm just going to pick on two areas that I think are really important. The first one is the financial sector. Why is the financial sector so important? If we think about it, that's how firms get money to grow and invest. That's how a new startup that's going to create new jobs can get access to financing. It's how households save. So we can ensure that households have enough money or get adequate return to their savings. I think the financial sector is sort of at the core of a lot of what's happening. It's also, of course, at the core of what the IMF does. So I may have a bias in looking there. What would we recommend? There's been a lot of progress on interest rate liberalization. It should be finished. The key remaining interest rate that's controlled is the deposit rate. There's a ceiling on it. It just so happens that that's a very important distortion. It's really important to remove that. The second one is maybe a bit technical, but China doesn't have a policy interest rate. It doesn't have a way to signal to the markets or to influence the markets using a policy interest rate. So the second thing would be to establish a policy interest rate. The third one is the hardest, and it's break the web of implicit guarantees in China. Right now, between savers, intermediaries, and borrowers, there's this tangled web of implicit guarantees, which means that very rarely is there a default in China, which means it's really hard to price risk. How do you price risk in an economy when there's really rarely a default? If I look at this huge growth in wealth management products, think of mutual funds in China. It's really hard to find a case. In fact, I can't find a case, maybe some in the audience could, of a fixed income wealth management product that lost money. This leads to the misallocation of capital. This leads to the misallocation of resources. This is preventing China from growing faster. It's preventing China from moving to a more sustainable growth path. Breaking the web of implicit guarantees is maybe good economist speak for saying more tolerance for bankruptcies and credit events and defaults. That's what it comes down to. And that includes state-owned enterprises, what we like to call SOEs. Which brings me to the second reform that I want to talk about, which is SOE reform. And the previous speaker had great numbers on private sector job creation, which means I can be quicker because I was going to go over the same numbers. Somehow it's a misunderstood fact, although Nick Lardy up at the Peterson Institute in Washington has a great book documenting this in extraordinary detail. China did, if we look back in history, the last 30 years, okay, for China that's not history, I'm an American, for me that's history. China had an average growth rate of 10%. This is a remarkable accomplishment, and it lifted over 500 million people out of poverty. Truly a remarkable accomplishment. It wasn't an accident, and it wasn't luck. China, at key points in time, implemented what were very difficult reforms that actually unlocked the growth potential. The most recent wave of dramatic reforms was in the 90s, where the leadership in the 90s actually reformed state-owned enterprises in manufacturing and laid off some 30 to 40 million workers, depending on how you add it up. Think about that, 30 to 40 million workers. Obviously a very difficult reform. Then China joined WTO in the mid-2000s. Guess what happened? SOEs left the manufacturing sector, and there was huge job creation in private sector manufacturing, as explained by the previous speaker. Way more than tens of millions of jobs were created in private sector manufacturing. And this sustained China's growth up until the global financial crisis. In essence, we need something similar now in the service sector. So we've had a lot of reform in China in manufacturing, but things like financial services, logistics, healthcare, which was mentioned earlier, education, these are all areas ripe for those kind of reforms to unlock that same potential where there can be huge private sector-led, very dynamic growth. In the end, all of these reforms will move China to the fastest sustainable growth rate, which would be faster today. So, good for China. We have slower, it's safer, more sustainable. It's clearly good for China. Let me argue it's also good for the world. China's been explaining more than 1/4 of global growth since the global financial crisis. Obviously, I get a lot of pushback when I try to tell people that slower growth in China today is good for them. Why is it good? Because if we can look past today, if we can look to the future, again, just like the runner, China growing slower today is going to mean much higher income for China in the future. With China now the world's largest economy by our math, a larger, stronger China is good for China and clearly good for the global economy. We like numbers at the fund. We've crunched some simulations. If you look at a China with reforms versus the scenario of China without reforms, 5 years from now, income in China, so income is 5% higher, which translates into 1 percentage point in global GDP. So China's successful reform today, accepting somewhat slower growth, but moving to a more sustainable growth path, will actually lead to 1 percentage point higher global GDP growth 5 years from now, or 5%.